Howdy, y'all. Welcome back. It's the weekly economic update for Monday, November 1st, 2021. I trust everyone had a fantastic weekend out there in interwebs land. Astros saved their season last night by taking Game 5. So fingers crossed that they pull it out and win the next two games. So I know last night was like, screaming and yelling and, very, very tough. So as far as the weekend, I got a lot of stuff done, got chores done, got all the pine needles yanked out of the gutters, which if you've ever seen the front of my house, the roof is very high up from the front, not so much in the back because we're kind of built into a hillside. So a lot of fun scaling the ladder. Felt like I did probably 10 sets of squats by the time I was done getting my old butt up and down that ladder. So anyways, what else? Weather was kind of nice. Well, except for yesterday it was kind of gray. Today it looks like a Houston winter day. It's just overcast, kind of gross. We had some snow falling from the sky a little while ago. So nothing major. So you don't have to send out St. Bernard with some rum for me or anything. But all right, well, let's go ahead and jump into what's going on in the wrong one. All right. So let me blow this up a little bit more for you. All right. The weekly economic update. The week on Wall Street, a fresh wave of positive corporate earnings surprises sent markets to new record highs last week. The Dow Jones Industrial Average increased 0.4. The S&P 500 was up 1.33. NASDAQ was up 2.71. And International was up 0.68. Earnings drive market. Excuse me. The week kicked off with the Dow Jones Industrial and S&P 500 setting record highs as financial markets carried over the previous week's price momentum. Stocks continued to climb on a string of forecasts beating earnings results, with about half of the S&P 500 constituent companies having reported earnings. More than 80% of them have beaten Wall Street analyst consensus estimates. Based on the results, earnings for all S&P 500 companies are expected to come in approximately 39% above third quarter of last year. Again, not a shock. Last year was all screwed up. Stocks overcame disappointing earnings from two mega cap tech names on Friday to maintain the week's solid gains. GDP growth slows while businesses managed to post strong earnings in the third quarter. The first look at economic growth came in below consensus estimates. GDP grew at 2% annualized rate in the third quarter, a slowdown from the two previous quarters, each of which posted annual growth rates in excess of 6%. The spread of the Delta variant and backlogs in supply chain were two major factors dragging on economic activity. I wonder how long the people in the world are going to continue to blame Delta variant and, people just got to get back to work. I mean, if you get sick and die, oh well, crap happens. All righty. Economic data this week. Monday, today, is the ISM, the Institute for Supply Management Manufacturing Index. Wednesday, ADP employment report comes out. Factory orders, ISM Services Index. The FOMC announcement is also on Wednesday. Thursday, we have jobless claims. Friday, employment situation. We have a lot of companies reporting earnings this week. Monday is Simon Properties. Tomorrow is Pfizer, Activision, Amgen, Marathon Petroleum, ConocoPhillips, Prudential, Mondelez International, T-Mobile, and Estee Lauder. Wednesday, CVS, Qualcomm, Electronic Arts, Humana, Booking Holdings, Match Group, Emerson Electric. Thursday, Square Inc., Albemarle Corporation, Southern Companies, Cigna, Skyworks, Regeneron, and Friday is DraftKings. And that looks like everything for this week as far as the weekly update. Got two white papers going out this week. The first one's titled Wise Decisions with Retirement in Mind. All right, let's go ahead and jump into this. Some retirees succeed at realizing the life they want. Others don't. Fate aside, it's merely a matter of investment decisions that make the difference. There are certain do's and don'ts, some less apparent than others, that tend to encourage retirement happiness and comfort. Retire financially literate. I think this is super important. Some retirees don't know how much they need, how much They don't know. They end their careers with inadequate financial knowledge and yet feel they can prepare for retirement on their own. They mistake creating a retirement income strategy with the whole of preparing for retirement and gloss over the longevity risk of their estate, and potential healthcare expenses. The more you know, the more your retirement readiness improves. The goal to retire debt-free. Or close to debt-free. Even if your retirement savings are substantial, you may want to consider reviewing your overall debt situation. Having a lot of debt, I mean, that's a tough thing as people are saving for retirement is, not paying off everything now and, having a little bit to save for the future. In a perfect world, I recommend everybody save 25% of what they make. It's a nice, easy round number. If you save 25% of your gross income, odds are you're probably going to be in a really good spot, 20, 30, 40 years down the road. Now, if you got to manage, raising kids and saving for all the things that comes with having a family, that's where that balancing act comes, and where the benefit of, using a financial planning software to, analyze, do I pay a little more now, or do I save a little more now? Or do I pay down my debt? Do I, do a snowball strategy to pay it all down while at the same time still saving up? So there's a lot to consider. So, but being not being beholden to anyone gives you a ton of freedom. Retire with purpose. There's a difference between retiring and quitting. Some people can't wait to quit their jobs at 62 or 65. If only they could escape and just relax and do nothing for a few years. Wouldn't that be a nice reward? Relaxation can lead to inertia. However, and inertia can lead to restlessness, even depression. You want to retire to a dream, not away from a problem. And, I think that's probably the biggest thing, as people reach, their late 50s, early 60s, really start thinking about, what do you want to do for the next, say, 20 or 30 years of your life? You don't want to go to work anymore, especially if the job you did wasn't exactly something that was ideal or enjoyable. But, really, having a plan for what you're going to do to keep busy. I can speak for my own grandparents who, when they retired, I think my grandfather retired in 92, right after I graduated high school. And, they just passed away 7 years ago. So they had a pretty long retirement, considering, they didn't take real good care of themselves when they were young, but, they still had lived a pretty long life. But, they kept busy. I know my grandfather was a city councilman at the city of Kemah, and they were very involved with Elks Lodge, and they were big sailboaters and were part of a group that would sail up and down the Texas coast a couple times a year. So, keeping busy is important. You just don't want to sit around and, wait for, I used to say Alex Trebek to come on, but he's dead. Wait for Jeopardy to come on in the afternoon. So, keeping busy is very important. Also, staying physically active is also important too. All right. Retire healthy. Smoking, drinking, overeating, a dearth of physical activity. All these can take a toll on your capacity to live live life fully and enjoy retirement. It's never too late to change these habits. That may lead to poor health. I think that's right. As you get older, the things you do in your 20s and 30s really make a difference when you get to your 40s and 50s. So taking care of yourself when you're young, I'm not saying don't have fun, but it's all about balance. Retire where you feel at home. It could be where you live now. It could be a nearby place where the scenery and people are uplifting. If you find yourself lonely in retirement, then look for ways to connect with people who share your experiences, interests, and passions, those who encourage you and welcome you. The social interaction is one of the great intangible retirement benefits. All right, that's that. So like I said, staying busy is super important the older you get. Why is this not getting any bigger? Oh, well. All right. This next one is tax changes. What's in, what's out. All right. While still too early to draw any final conclusions, Congress is getting closer to outlining what tax law changes are under consideration to pay for the proposed $1.7 trillion Build Back Better plan. Where have I heard Build Back Better? Oh, the EU. They say it a lot over there, too. For now, it appears that changes to capital gains and personal tax rates are off the table. Yay. The conversation is shifting to a new corporate minimum tax, while adjustments to estate taxes may still be under consideration. Yeah, this global estate tax is a bunch of garbage. I'm going to cover that in a minute. Investors cheered as some of the tax law uncertainty was lifted. In October, the Standard & Poor's stock index tracked nearly 7%, while some initiatives are left behind. Others are seeing renewed interest. A growing number also appears to be warming up to the idea of a billionaire's tax, a special tax designed to focus on 800 or so wealthiest Americans. I don't know anyone who's in favor of this. So maybe a few Democrats out there who don't mind pilfering the productive to give to the government, but I'm not a fan of it. All right. Critics of the billionaire tax remind the legislature that when the alternative minimum tax was introduced in 1969, it was targeted at 155 individuals with adjusted gross incomes above $200,000 who paid zero federal income tax on their 1967 return. But by 2017, nearly 5 million taxpayers were assessed a minimum tax. So, yeah, I know the AMT is a big mess for people, especially as you get older. So, yeah, not cool. It ain't over till it's over, said baseball legend Yogi Berra when his 1973 New York Mets appeared to be out of the National League pennant race. The Mets eventually won the pennant, but lost the World Series in 7 games to Oakland. If you're feeling unsettled as Congress continues to work on these tax laws, please reach out. Oh, that's me. If you want to talk about baseball, the Baseball World Series, give me a call. Hey, I'll talk baseball for hours. So you're welcome to give me a buzz about that. All right. First article out there in the mainstream comes from First Trust. It's Eyes on the Fed. Let's see. Let me see if I can get this a little bit bigger. All right. Investors will be focused on the Federal Reserve this week, and our expectations is that it will finally announce an overdue tapering of quantitative easing. In addition, we expect Chairman Jerome Powell to make it clear that in the press conference that he expects tapering to be completed by mid-2022. Inflation is clearly a problem. The CPI is up 5.4% from a year ago. When October data arrived, the year-ago comparison will likely be 5.7%. The largest increase since the early 1990s. Some of this is transitory, but not all of it. Not by a long shot. Housing rents were held down artificially until early September due to limits on evictions. Once nationwide eviction limits ended, rents escalated in September, and we expect to see more of the same in the foreseeable future. That's important because rents make up more than 30% of the CPI. Given the likely pace of inflation in October, the real federal funds rate is running about negative 5.6%. That's a record low, even more deeply negative than the negative 5% in early 1975 and negative 4.8% in mid 1980. Both of which were the ends of recessions, not almost a year and a half into recovery. Not almost a year and a half into recovery, likely we are right now. In other words, the current economic environment doesn't just warrant tapering, but rate hikes. Unfortunately, rate hikes aren't happening anytime soon. We would be surprised if just one rate hike at the very end of 2022, but the starting of a hiking cycle could be postponed until 2023. Yeah, the interest rates being held artificially low for more than a decade. When that bubble pops, it's going to be a mess, in my opinion. So we'll see where it goes. First, the Fed is unlikely to raise rates until after it's done tapering, so that alone delays hikes until at least mid-2022. Second, we think the Fed will be reluctant to start hiking after a few months before the midterm elections. Yeah, because you don't want to screw up a good thing that we got going on right now. And third, personnel changes at the Fed will likely give the Fed more dovish tilt in 2022. There's already a vacancy on the Fed board, 2 openings to fill for bank presidents in Dallas and Boston. And we think Trump appointees Richard Clarida and Randy Quarles will be gone mid-2022 due to their expiration of their terms as vice chairman and vice chair for supervision, respectively. The problem with monetary policy is that M2 measurement of the money supply is up 36% since February of 2020 versus a trend of about 6% annualized pre-COVID. That surge in M2 is like a cow that's been eaten by a snake, gradually moving through. As long as the Fed doesn't regurgitate the extra money, the cow isn't going away. Which in this case means a devaluation of money relative to goods and services. That doesn't mean higher inflation forever, but it does mean a prolonged period of higher inflation until the extra M2 is fully digested by the economy. I've been talking about this for a while. This inflation that we've been seeing, it's going to take probably a year or two at a minimum for all the prices to, settle or recalibrate based upon the amount of cash in the system. So, if you're complaining about your gas and food being more expensive, you get the government you deserve. Central banks fuel new bets on tighter money as inflation rises globally. Hey, more of the same type of stuff. Short-term bond markets have reacted to recent pivots by policy makers in Canada and the UK. This is from the Wall Street Journal by Nick Tamaras. I'm sorry, I'm probably butchering that. Stubbornly high inflation across more wealthy economies last week prompted a shakeout in bond markets as investors began expecting central banks to quickly tighten monetary policy. All eyes this week will be on the Federal Reserve, which is likely to begin winding down its $120 billion a month asset buying program with an eye towards ending those purchases by next June. Markets showed investors are increasingly betting on the Fed raising U.S. interest rates next summer, following recent inflation reports and signals from other major central banks that they are moving towards tightening policy. All right. Speculation that the Bank of England could be the first major central bank to nudge up interest rates has intensified in recent weeks after Governor Andrew Bailey warned on October 17th that the central bank will have to act if surging prices for goods and energy push up Britain's expectations for future inflation. Annual inflation in the UK was 3.1% in September, but is expected to rise to around 5% in the coming months, more than twice the bank's 2% target. Officials will meet to decide on rates on Thursday. Investors in interest rate futures markets put the chance of a rate increase at 62%, according to the CME Group. The Bank of Canada surprised markets last week when it ended its government bond purchase program and moved up its time frame for when it might first raise its benchmark interest rate from its current near zero level. Meanwhile, the Reserve Bank of Australia, which has had a policy meeting on Tuesday, stunned investors when it declined last week to defend its 0.1 interest rate target it had set on bond yields that mature in April of 2024. Wow, that's a hell of a return. Bond investors sold off government debt following the release of a stronger than anticipated inflation report. The RBA's move fueled expectations that will scrap the program known as yield curve control at this week's meeting. And if so, this is startling about face, said Ben Jarman, an economist at JP Morgan Chase. The changing inflation outlook makes RBA's overall policy untenable, said David Plank, head of Australian economics at Australian and New Zealand Banking Group. So, yeah, I think that, as this happens, it's going to cause some ripples through the economy. So we will see what goes on there. I'll attach this article if you want to read that. All right, this next one is G20 backs tax overhaul. This is, like I mentioned earlier, for taxing rich countries. All right, leaders of the world's biggest economies endorsed a deal on corporate taxation that they hope will safeguard the future revenues and offer stability to businesses that operate internationally. The main beneficiaries are likely to be rich countries, including the U.S. In the opening session of their summit in Rome, leaders of the group of 20 major economies have their blessing to a global pact that has been more than a decade in the making, according to officials. The agreement comes in two parts. It sets a minimum tax rate of 15% on the profits of large businesses and will raise additional revenue for most governments. And it shifts tax revenues to where companies sell to consumers rather than where they are based. Rich country governments are set to be the main winners from both parts of the deal, according to one analysis. Additional revenues from the U.S. For the U.S. from the minimum tax will be 15 times that of China. Another report estimates that the total boost to 52 developing countries from the new way of allocating tax revenues would be about $1.5 billion to $2 billion a year, a fraction of the deal's benefits for rich countries. G20 aims to limit the ability of businesses to lower their tax bills by recording their profits in low-tax countries such as Ireland. That became easier with globalization as businesses were able to relocate production across many different countries, and with the rise of digital technology, which allowed businesses to make their sales in countries which had little physical presence. The deal aims to end what governments call the race to the bottom on corporate tax bills. So, yeah, I mean, that's basically the gist of it. The powers that be that seem to think they run our lives want to put a minimum tax on all businesses. And well, I'm not cool with it really, but I don't really get a say in the matter. So whether or not this actually gets pushed through, I mean, this will have to go through Congress and will have to be voted on. Whether or not that actually gets done, as of right now, it's just a resolution. So it doesn't really mean anything. Personally, I don't even know if our republic is going to be around in 5 years. So I'm not really that concerned. All right. Well, that's everything I had for the news over the weekend and going into this week. If anybody needs anything from me, feel free to give me a call or send me an email. Smoke signals work too. Sorry, hit the mic. But like I said, if you need anything, don't hesitate to reach out and call. If you have a question about something that I haven't covered recently, don't hesitate to ask a question. That's certainly what I'm here for. So I hope everyone has a fantastic week. And let's see here. Like I said, hope everyone has a fantastic week. And I will definitely be back by Friday. And let's go Astros. Where is that? There we go. Bye.